They told you it would crash. They told you Friday was the top. They told you to take your profits and run. But Tuesday morning, the market gave its answer. And the answer was a green candle that obliterated the bearish case in a single hour. Look at the screen. Silver is trading at 69.14. Earlier today, we hit 69.40. That is a move of nearly $2 since the open. That is almost 3% in a single trading session. Commodities do not usually move 3% on a Tuesday morning without a war starting. What we are witnessing is not a trade. It is a liquidation. The banks that tried to short the market on Friday are now trapped. They are underwater, and they are doing the only thing they can to survive. They are panic buying. They are slamming the market buy button with both hands, trying to cover before the price hits $70, because they know what we know. They know that $70 is the point of no return. If we break it, the algorithms take over, and the price enters a vacuum that goes straight to $75. This is the Tuesday Massacre for the shorts. To understand the violence of this move, you have to look at how the week began on Sunday night when the Asian markets opened. There was no hesitation, no dip, no test of the lows, just a gap up. The price jumped immediately and then did something very specific, something technical analysts call a gap and go. Usually, when a price gaps up, it comes back down to fill the gap. It tests the previous close. But this time, it didn't look back. It opened high and traded higher. That is a sign of extreme urgency. It means buyers were not willing to wait for a pullback. They were not willing to haggle over 10 cents. They just wanted in. Who buys like that? Retail investors wait for dips. Hedge funds use limit orders. The only entity that buys with reckless abandon is a forced buyer. Someone is receiving a margin call. Someone short whose broker just said, "Close the position now, or we will close it for you." This confirms the thesis from the weekend. The margin call was real. The banks spent 48 hours assessing the damage from Friday. And on Tuesday morning, they pulled the plug. We are watching a forced liquidation in real time, and the fuel for this fire is the bank's own money. Let's talk about the high of the day, $69.40. Why did we stop there? Why not go straight to $70? Because $70 is a massive psychological wall. Traders call it a big figure. Humans are programmed to take profits at round numbers. As we approached 69.50, day traders started selling. They wanted to lock in the win. But here is the bullish signal. We didn't crash back to 67. We pulled back slightly to $69.14, and we are holding, hovering just below the ceiling. In technical analysis, this is called banging on the door. Imagine a battering ram hitting a castle gate. The first hit weakens it, the second hit cracks it. We just took the first hit at 69.40. The fact that the price is staying up here, waiting, gathering strength, suggests we are preparing for the second hit. And usually the second hit is the one that breaks the gate. Sellers at $70 are being absorbed. Every time someone sells a contract at $69, a buyer steps in. Eventually the sellers run out. And when there's nobody left to sell at $69.99, the price teleports to $70, $10. Visualize the trading desks of New York right now. Imagine you are a trader at a major bullion bank. Your job is to manage the short book. Your bank has sold millions of ounces of paper silver to hedge funds and industrial clients. On Friday, you thought you kept the price at $65. Today, it's $69. You are down $4 on millions of ounces. Your P&L screen is flashing red. Your risk manager is standing behind you, screaming to reduce exposure. What do? Do you double down and short more? No. Your risk limits are maxed out. You have to cover. You have to buy back the paper you sold. But every time you buy, you push the price higher. If you buy 500 contracts to save yourself, you push the price to $69.50. That forces the other bank down the street to panic, so they buy, which pushes the price to $69.60. This is the feedback loop of doom for the shorts. They are trapped in a room with only one exit, and the exit is shrinking every minute. This is why the rally feels relentless. It isn't driven by greed. It is driven by fear. Fear of banks losing control of their own balance sheets. Now look at the news. Go to the financial homepages. Do you see silver soars to 69 as the top story? No. They are talking about stocks, interest rates, and tech earnings. Why? Because a soaring silver price is an embarrassment to the establishment. It signals inflation. It signals a loss of confidence in the dollar. It signals that managed money is losing control. The media blackout is actually bullish. It means we are still in the stealth phase. The herd hasn't stampeded in yet. Grandma isn't calling. Your Uber driver isn't asking about silver. This rally to $69 is being driven by smart money and desperate money. The dumb money is still on the sidelines. When headlines finally break, when CNBC runs the silver at 70 special, that is when the next wave of capital hits. And if we are at $69 without the public, imagine where we go with the public. Right now, the rally is pure institutional flow. That is the healthiest kind of rally you can have. So the trend is up. The banks are covering. The $70 wall is cracking. But there's a twist. The calendar. It is late December. Holiday trading season. Christmas approaching. New Year approaching. Senior traders are leaving for vacation. Volume thinning out. Usually low volume means boring markets. But in a squeeze, low volume means danger. It creates a liquidity trap. If there are no sellers at the desk because they're skiing in Aspen and a massive buy order comes in, the price can jump $5 in a minute because nobody is there to stop it. In the next part, we will explain the holiday squeeze. We will show why the next 2 weeks might be the most volatile period of the year. We will look at thin order books and why they favor the bulls, and we will discuss the 70 trigger. If we break $70 in a thin market, where does the elevator stop? The banks are praying for a quiet holiday. They are not going to get it. To understand why silver is moving $2 a day, you have to understand liquidity. Liquidity is the ability to buy or sell an asset without moving the price. Imagine a swimming pool full of water. If you jump in, the water level barely rises. That is a liquid market. Now imagine a bathtub. If you jump in, the water overflows. That isn't a liquid market. Usually silver is a swimming pool. Thousands of buyers and sellers, deep order books, plenty of contracts. But during Christmas week, the swimmers leave. The banks reduce their market-making activity. Hedge funds close their books for the year. The order book, the list of people waiting to buy and sell, gets thin. Instead of 500 contracts sitting at $69.50, maybe there are only 50. So what happens when a whale comes in and buys 500 contracts? In a normal market, the price ticks up a cent. In a thin holiday market, they chew through the 50 contracts instantly. Then they hit the next order at $69.60, then $69.70. They chew through the entire ask side of the book in seconds. The price spikes. This is slippage. And right now, slippage is the bull's best friend. The banks usually use their deep pockets to absorb buying pressure and keep the price stable. But the senior traders, the ones with authority to deploy billions, are on vacation. They are in Aspen. They are in the Caribbean. They are not at the desk. So the market has no shock absorbers. If a big buy order hits, the price moves fast. This creates a vacuum. We are moving up, not because there is infinite buying, but because there is zero selling. That is why the rally feels effortless. It is not a flood of buyers. It is the absence of sellers. Now consider the human element. Who is manning the trading desks at JP Morgan and Goldman Sachs right now? Not the managing directors. It is the skeleton crew, the junior traders. The 25-year-olds who drew the short straw have to work Christmas week. Put yourself in their shoes. Your boss is on a yacht. He left you with one instruction. Don't lose money. Keep the book flat. Suddenly, silver spikes $2. Red lights flash. Risk alarms scream. The value at risk model says the bank is losing millions. What do? Do you have the courage to double down and short more silver to stop the rally? No, you don't have the authorization, and you're terrified of getting fired. So you do the safe thing. You cover. You buy back the position to stop the pain. You neutralize the risk. You think, better to explain why I closed the trade than explain why I lost $50 million. This is why holiday rallies are violent. The adults are gone. The kids are scared. And scared traders buy to cover. We are watching a market driven by the path of least resistance. And right now, the path of least resistance is up. There's a technical accelerant here too, gamma. Options expiration is looming. There's a massive wall of call options at $70. Market makers, the banks, sold these options. They are short the calls. As the price approaches $69.40, their algorithms have to hedge. They have to buy futures contracts to offset the risk of the calls paying out. In a liquid market, they can do this quietly. In a thin market, their buying pushes the price up, which forces them to buy more, which pushes the price up again. This is a feedback loop inside a vacuum. The algorithm doesn't know it's Christmas. It just knows it has to buy. It hits a thin order book, spikes the price, and triggers more buying from itself. This is how you get a flash smash to the upside. Silver could hit $72 in minutes if this loop ignites. It isn't a fundamental demand. It is structural fragility. The system is brittle, and $70 is the hammer. While the paper market is thin, the physical market is practically closed. Refineries and mints shut down for the holidays. They do maintenance. They clean machines. They audit inventory. This means the new supply is zero for 2 weeks. No new silver eagles minted. No new bars coming off the line in Switzerland. The pipeline is paused, but demand never sleeps. The internet is awake. Retail investors are buying online. Industrial procurement managers are placing orders. So you have a steady demand meeting zero new supply. This drains existing inventory at dealers. By the time refineries reopen in January, shelves will be bare. Backlogs will be weeks long. This creates the January effect. Investors know supply will be tight in January, so they front-run it in December. They buy now to avoid delays later. This pulls demand forward into the thinnest week of the year. That is why premiums stay high even as spot rises. Usually premiums drop when spot rises. But dealers know they can't restock until mid-January, so they keep premiums high to slow buying. It isn't working. People are buying anyway, so liquidity is gone. Juniors are panic buying, robots are hedging, refineries are closed. All roads lead to one number, $70. In the next part, we will look at the technical wall. $70 isn't just a number, it is a multi-decade resistance line on inflation-adjusted charts. It is the line in the sand for the banking cartel. Breaking $70 changes the trend from linear to exponential. We will look at blue sky targets above $70, and we will discuss the psychological impact of a $70 handle. When silver starts with a 7, perception shifts from cheap to unstoppable. The battle for $70 begins now, and with the market this thin, the wall might be made of paper. Why does the market care about $70? Why not $69, $80? Because human beings are irrational. We are programmed to respect round numbers. In trading, this is called big figure resistance. When a trader sees the price approaching $70, their brain says, that is expensive, that is a good place to sell. Hedge funds place limit sell orders at $69.99 to front-run the wall. Option writers defend the $70 strike to avoid paying out. It becomes a self-fulfilling prophecy. The price hits $69.90 and bounces off like it hit an electric fence. We saw it today. We hit $69.40 and pulled back. That was the warning shot. The sellers stepped in to defend the castle. But here's the secret of a short squeeze. Round numbers are magnets. Yes, they repel price initially, but if the price keeps coming back, if it keeps knocking, the magnet flips. It starts to pull. If we break $70, even by a cent, it triggers a cascade of stop-loss orders from the bears. Everyone who bet against silver has their stop set at $70, $10. When those stops trigger, they turn into market buy orders. The wall of resistance instantly transforms into a wave of buying. That is how you get a blow off top. The defenders become the fuel. Look at the long-term chart. Go back to 1980, the high was $50. Go back to 2011, the high was $49. We are currently trading at $69. Do you know what this means? It means there is no price memory. There's nobody alive who bought silver at $75 and is waiting to sell to break even. Those people do not exist. There are no bag holders overhead. When an asset enters a price range it has never seen before, it is called blue sky. In the blue sky, technical analysis breaks down. There are no resistance lines, no Fibonacci retracements from previous highs, only momentum. In this environment, price can move irrationally fast. It moves until it finds a seller. But if everyone is in profit and everyone thinks it is going higher, who sells? Nobody. So the price has to go to $80 or $90. It has to go high enough to convince diamond hands to finally let go. We are currently in the blue sky. The only resistance is the artificial sell walls put up by the banks. Once those walls are overrun, there is nothing but open space above us. There's a subtle but powerful shift that happens when the handle changes. The handle is the first digit of the price. When silver went from $19 to $20, perception changed. When it went from $49 to $50, the world went crazy. Moving from 60-something to 70-something changes the narrative. To the retail investor, $60 feels like an expensive $50, but $70 feels like almost $100. When silver hits $72, the psychological anchor shifts. People stop looking down at $50. They start looking up to $100. The target becomes triple digits. This pulls in momentum chasers, the people who only buy things making new highs. This is Soros's principle of reflexivity. Higher prices attract more buyers, which leads to higher prices. Breaking $70 is the signal to the momentum crowd that the trend is accelerating, not ending. It validates the thesis. It turns silver from risky into a not owning silver is risky. Now think about your portfolio. If you are holding physical silver, today was a good day. You're up 3%, but it is more than that. You are feeling the wealth effect. When your assets rise, you feel richer, smarter, and more confident. The confidence is dangerous for the banks. Why? Because a confident holder does not sell. A confident holder buys more. The banks are relying on you to be weak. They need you to look at $69 and say, thank heavens, I can finally get out with a profit. But you are not saying that. You are looking at $69 and saying, I was right, and I want more. This seller strike is the fundamental problem for the shorts. They can print paper contracts, but they cannot print your willingness to sell. If the price goes to $78 and nobody sells, it goes to $71, it goes to $75. It goes until the pain of not selling overcomes the greed of holding. Right now, greed is winning. And the wealth effect is creating a feedback loop where higher prices make holders more stubborn, not less. We also have to look at the industrial buyer, the procurement manager at Samsung or Tesla. They're watching the same screen. They see $69. They see the relentless move up. At what point did they panic? At $60, they were annoyed. At $65, they were concerned. At $70, they are terrified. $70 is the level where budget forecasts break. It is the level where they have to go to the CFO and ask for more money. It is the level where they realize just-in-time inventory has failed. If we break $70 this week, we will see panic hoarding from the industry. They will stop buying for next month and start buying for next year. They will try to lock in the price before it hits $100. This inventory build pulls massive demand forward. It takes future demand and stuffs it into the present. That is how you get a vertical spike. Industry is not reacting to price. They are reacting to the trend. And the trend says, buy now or pay double later. So $70 is the key. The blue sky is open. The industry is panicking. But markets are treacherous, especially in a holiday week with thin liquidity. What happens if we fail at $70? What happens if the banks engineer a double top and smash it back down? And if we do break out, how do you trade it without getting wrecked by volatility? In the next part, we will look at the endgame strategy. We will show the pivot points to watch. We will explain why leverage is suicide right now. And we will leave you with the final verdict on whether this is the top or just the beginning. The market is moving fast. You need a plan. Let's finish this. We have reached the end of the trading day. The sun is setting in New York. The closing bell is ringing. Silver stands tall at $69.14. Take a deep breath. Do you realize what just happened? The banks tried to crash the market on Friday. They failed. They tried to scare you out of your position. They failed. And today, on a quiet Monday before the holidays, silver rallied nearly 3%. This is a statement. It is the market declaring that the path of least resistance is higher. It is proof that the physical shortage is more powerful than paper manipulation. But now we have to talk about the hardest part, holding. It is easy to hold when you are losing money. You have no choice. It is incredibly difficult to hold when you are making money. The temptation to sell, to lock in profits, to ring the register is overwhelming. Yet the discipline to sit tight is what separates winners from casualties. In trading, we don't guess, we react. We look at key levels on the chart. Right now, there are two numbers that matter. Everything else is noise. Number one, the ceiling is at $70. This is resistance. If we break $70 with high volume, the trade enters hyperdrive. Shorts capitulate. The media wakes up. Price goes vertical. We want to see a daily close above $70 to confirm the breakout. Number two, the floor at $16. This is support. Remember Friday's high? It was $67.14. Technical analysis says old resistance becomes new support. If price pulls back tomorrow, we must hold $67. If we bounce off it, that's healthy. It's a retest. But if we crash below $67, it means today's rally might have been a bull trap. It means sellers are back in control. So your strategy is simple. Watch $67. As long as we stay above that line, you do nothing. You sit on your hands, you let the profit run. If we break below it, you reassess. But right now, we are $2 above danger. The buffer is thick. The trend is your friend. Now a warning. I know some of you are looking at this chart and thinking, silver is going to the moon. I should buy call options. I should use a margin. I should bet the farm. Do not do it. Volatility kills leverage. In a holiday market with thin liquidity, prices can swing $5 in an hour. If you are using leverage, a $5 drop wipes you out. You get a margin call. The bank sells your position. And 10 minutes later, the price goes back up. You were right about direction, but you lost everything because of volatility. The banks know you're greedy. They will engineer shakeouts specifically to hunt leverage traders. They will drop the price just enough to liquidate gamblers, then resume the rally. The only way to survive a supercycle is to be unshakable. Physical silver has no leverage, no margin call. It sits in your safe. If the price drops $10, you still own the same ounces. If you want to win this game, you have to play defense first. Protect your position. Don't get greedy. We're entering a peculiar time of year, the Santa Claus rally. Historically, the last week of December is bullish for stocks and commodities. Why? Because sellers are gone. Shorts have closed their books. They are on vacation. They don't want to start a fight 3 days before Christmas. This creates drift. Prices float higher on low volume, like a balloon untethered. Without the weight of sellers holding it down, it drifts up. Silver could drift to $70 this week simply because nobody is standing in the way. Passive buying is powerful. It isn't explosive. It is quiet. It is relentless. Do not mistake low volume for weakness. In a shortage, low volume means no sellers. And no sellers means higher prices. Zoom out one last time. Where are we in the cycle? We have broken the 6-year consolidation. We have broken the handle of the cup and handle pattern. We have broken psychological barriers at $30, $50, and $60. We are in the early innings of a historic repricing. This is not the top. This is recognition. The world is just starting to recognize silver is essential for energy, essential for tech, essential for survival. The move to $69 is just the market pricing in the current deficit. It hasn't even started pricing in the future deficit from Samsung batteries or Indian solar panels. So do not let fear of heights paralyze you. Yes, $69 feels high compared to $20, but compared to the utility of the metal, compared to mining costs, compared to the money supply, it is still cheap. So here's the plan for the rest of the week. Watch $70. It is the next domino to fall. Respect volatility. Do not use leverage. Ignore intraday noise. Holiday trading will be choppy. Hold physical. It is the only asset with no counterparty risk. The banks lost control today. They tried to stop the rally. They were overrun. Now they are on the defensive. They are covering. They are chasing. They are doing exactly what we predicted. You were right. You held. You stacked. You waited. Now enjoy the show. The Monday Massacre was a victory for the bulls, but the war is just heating up. The day is won, but the war is just beginning. Silver closes at 69.14 and the battlefield shifts from intraday chaos to the long game of conviction. The banks are wounded. They tried to cap the rally at 65, they failed. They tried to defend $67, they failed. Now they are staring at the fortress of $70 and the walls are cracking. The question is not whether silver will test $70. The question is how the market reacts when it breaks. Because once the handle changes, once the first digit flips from 6 to 7, the psychology of the entire market changes with it. This is the final countdown. 2 pivot points matter. The ceiling is at $70 and the floor at 67. Above $70, the rally enters hyperdrive. Shorts capitulate. Algorithms chase momentum. The media wakes up. Price goes vertical. Below $67, the rally risks becoming a bull trap. Sellers regain control. Confidence cracks. That is the battlefield. 2 numbers. Everything else is noise. Your strategy is simple. Watch those lines. As long as silver stays above 60s and 7s, you hold. You sit on your hands. You let the profit run. If it breaks $70, you celebrate. If it breaks below 67, you reassess. Discipline is survival. But discipline is hard when greed whispers. The temptation to leverage is everywhere. Options traders are salivating. Margin gamblers are itching. They see the chart and think, this is the moonshot. I should bet the farm. Do not do it. Volatility kills leverage. In a thin holiday market, silver can swing $5 in an hour. A leveraged position cannot survive that. You get a margin call. Your broker sells you out. 10 minutes later, the price rebounds, and you are left with nothing. You were right about direction, but wrong about survival. The banks know this. They will engineer shakeouts to hunt the leveraged. They will drop the price just enough to liquidate gamblers, then resume the rally. The only way to win a supercycle is to be unshakable. Physical silver has no margin call. It sits in your safe. If the price drops $10, you still own the ounces. That is how you survive. Defense first, greed last. Now consider the calendar. It is late December. The Santa Claus rally is here. Historically, the last week of December drifts higher. Why? Because sellers are gone. Shorts have closed their books. They are on vacation. They do not want to start a fight 3 days before Christmas. This creates drift. Prices float higher on low volume. Like a balloon untethered. Without the weight of sellers, silver drifts up. Do not mistake low volume for weakness. In a shortage, low volume means no sellers. No sellers means higher prices. That is why silver can drift to $70 this week without fireworks. Quiet, relentless, inevitable. Zoom out. Where are we in the cycle? We have broken the 6-year consolidation. We have broken the handle of the cup and handle pattern. We have broken psychological barriers at $30, $50, and $60. We are in the recognition phase of a historic repricing. This is not the top. This is the beginning. The world is just starting to recognize silver is essential for energy, essential for technology, essential for survival. The rally to $69 is the market pricing in the current deficit. It has not even started pricing in the future deficit from Samsung batteries, Indian solar panels, or the Pentagon's restocking. The supercycle is young. The recognition is spreading. The repricing has only begun. So do not let fear of heights paralyze you. Yes, $69 feels high compared to $20. But compared to the utility of the metal, compared to mining costs, compared to the money supply, it is still cheap. The market is not irrational. It is catching up to reality. Silver is not a relic. It is the conductor of electrons, the lubricant of engines, the lifeblood of satellites, the keystone of missiles. It is the most strategic material of the 21st century, and the market is finally waking up to that fact. Here is the plan. Watch $70, respect volatility, do not use leverage, ignore intraday noise. Holiday trading will be choppy. Hold physical. It is the only asset with no counterparty risk. The banks lost control today. They tried to stop the rally. They were overrun. Now they are on the defensive. They are covering. They are chasing. They are doing exactly what we predicted. You were right. You held. You stacked. You waited. Now enjoy the show. The Monday Massacre was a victory for the bulls. The Tuesday surge was confirmation. The war for $70 is next. And when the gate splinters, when the magnet flips, when the stops trigger, silver will not walk through. It will run. It will teleport. It will reprice the world in a single breath. The countdown has begun. The fortress is cracking. The shorts are trapped. The algorithms are waiting. The public is asleep. The herd has not arrived. And you're already inside. This is the moment. This is the pivot. This is the final countdown to $70. Hold your ground. Protect your position. The war is heating up. The gate is splintering, and on the other side of $70 lies blue sky. Now enjoy the show. The Thursday Massacre was a victory for the bulls. The Thursday Massacre was a victory for the bulls.